Good afternoon, financial professionals. Abby Fletcher here of E4 Insurance Services, welcoming you to the BREW, Building Relationships Every Week. Thanks for tuning in today. For those of you joining the BREW for the first time, we like to start the BREWcast by celebrating today's National Day for May 19th. Today is National Fruit Slush Day. That's right, folks, whether you call it a Mr. Misty, a slushy, or a Slurpee, today we celebrate these icy delights. Back in the day, royal courts used to bring down freshly fallen snow from the mountaintops and spread crushed berries and mashed fruit on top. No need to hunt for snow today, guys. Just go ahead and treat yourself and others to a fruit slush in the sun. Today on the BREW, as part of our E4 exclusive series, we have our very own Bill Anderson, who serves as wealth strategist here at E4. Today, Bill will be sharing a fan favorite, Cylinders of Money, which happens to be a brainchild of Bill's, and how many of us in the industry learned how to best communicate LIRP, life insurance as a retirement plan. Feel free to use the chat box below while Bill is live. I'll be keeping a lookout for your questions. Also, all attendees are in a drawing for a prize, and we'll be announcing the winner shortly. Thank you for tuning in, and without further ado, Bill, welcome. The mic is yours.
Thank you, Abby, and I always learn interesting facts as part of this BREW, so thank you for sharing that. Good morning, good afternoon, wherever you're at in the country, and as the pre-marketing, whatever piece was put out there, who do you have as clients that are looking for other places to save monies? So we're going to talk today, I call it the Cylinders of Money. It's called the Life Insurance Retirement Plan. It's called the Super-Roth. It's called a lot of different things. But what I'm going to do is give you what I draw as a picture on a whiteboard, on a yellow pad. We're going to spare you the sloppiness of my writing, and we've actually prepared it in a PowerPoint presentation. But this is ideal for professional athletes, for doctors, attorneys, accountants, anybody really high income that you have where they're maxing out their qualified plans and they're looking for other places to save money. It can even be for the professional money manager. Yeah, that's intentional. Look in the mirror. A lot of you, this is something that if you're not doing this, you should really consider doing this. So again, we call it the Cylinders of Money, and I'm going to show you what we draw again in a PowerPoint fashion. And we're going to look really at any sort of investment that a client of yours might invest in. And we're going to look at it from 4 levels: contributions, accumulations, distributions, and trade-off. I'm going to start with the qualified monies, right? Your 401k, your SEPs, your solo Ks, etc. So contributions are pre-tax. They accumulate tax deferred. When they distribute, they're going to be taxable, and taxable is ordinary income. And then, of course, the trade-offs, we understand you can't get at it till 59 and a half, and at age 72, you have to start taking it. This is a great place to save money. This is where most individuals in our country save. They start, and when they max these out, they come to you and say, hey, advisor, what should I do? Well, a non-qualified portfolio is the next most common strategy or investment that somebody will do. Contributions are after tax, accumulations are taxable, distributions are taxable. The trade-off, it's liquid. These are wonderful accounts until they get to somewhere between $250,000 to $500,000 in size, and then the freight of that accumulation and distribution gets a little bit harsh, and your clients come to you and say, now what? Well, believe it or not, some of you are still using tax-free bonds. As we have this new tax implementation that most likely is going to happen under our current regime, what we're going to see is this is going to become a more popular investment again, right? So muni bonds are tax-free on the contributions. I'm sorry, after tax on the contributions with tax-free accumulations, tax-free distributions. The trade-off, they're somewhat liquid. What else do people look at? How about non-qualified annuities? Now, some of you on this call use these and like these. Others of you are like, nah, not my style. That's fine, but there's still a tool that clients use. So contributions are after tax. They accumulate tax deferred. The power of the tax deferral is very similar to what it is on the qualified monies, right? And the income or the distributions can actually come out tax favored. And then the trade-off is, because you're getting the tax deferral, you don't get to take them out until you're 59 and a half. But the good part of this level or this cylinder is there is no 72 where you have to start taking it, or you're going to be penalized if you don't, right? Now, what's interesting about non-qualified annuities, you need to understand that it's last in, first out accounting. So if somebody put in $100,000 and it grew to 250, so it's got $150,000 of growth. And let's say they're past 59 and a half, so there's not an early distribution penalty. And they come to you, they're 62 and they want to pull out 200 grand. Well, the way it works in a non-qualified annuity is you have to take in last in, first out first, right? So on that $200,000 distribution, 150 of it is going to be taxable as ordinary income. And then the other 50,000 of that is going to be return of your basis for 50,000, which is obviously not taxed. So that's how it works in non-qualified annuities. Going back to our cylinder, another common thing that high income and wealthier people invest in is real estate, right? There's two ways to do real estate. You can buy real estate as an investment income, or you can do the buy and hold kind of a strategy. For our example today, I'm using a buy and hold. So it's after tax contributions that your client put into some land. It accumulates tax deferred. It distributes taxable, so they sell it later, but they're only going to pay capital gains tax on that, not ordinary income. Who knows what that's going to be like in the future, right? Some of us are a little bit worried about it. And the trade-off, it's somewhat liquid. Generally, it goes up in value, but 2009, 2010, you would not wanted to have a forced sale of real estate, right? So how about life insurance? I mean, yeah, that's what we're getting to today. Well, let's understand how life insurance is designed. So the way it's usually sold is this way: high death benefit, moderately growing cash value. The difference between them is your cost of insurance. Now recognize I said how it's usually sold, okay? If you are looking at it as a cylinder of money, the way it's actually designed, you help your clients implement this. You're not selling them anything. You have a very low death benefit that has a cash value that pushes that death benefit up every single year. The corridor, as we call it in the insurance space, the cost of insurance is very, very low. So when you look at this, you'll see products that have been sold with the concept, but yet look like what's on the left-hand side of your screen versus what it should look like on the right-hand side. So it's not this way, it's that way. Very important to understand this, because you will bump into policies, old contracts from your clients that were taken out years ago, and they bought it with this idea in mind, but it's designed like it is on the left-hand side. Those are really easy replacement cases, and it's a lot of the business that we do here at E4. But I will also add that there was a Christmas gift last year. It was a couple days after Christmas, so the last week of the year, there was some new legislation that passed that affected the life insurance industry. I'm going to get geeky and technical for about 10 seconds. It's called Section 7702 of the IRS code. It's how much money you can hide inside of a life insurance contract. So it went into effect January 1 or January 2nd, but the carriers were not really able to illustrate it until literally the last month or two. So it's the middle of May right now. It was April and May of 2021, if you're watching this on a recording, that all of the carriers pretty much came out with this new software, their new illustrations. And what you're able to save inside of a life insurance contract today versus what it was prior to this year is about 30 to 35% more, having even a lower cost of insurance inside of a product design. So let's go back to the cylinders and complete this out for the life insurance. Contributions, of course, are after tax. They accumulate tax deferred. It's the power of the deferral in the real estate, the non-qualified annuities, and the qualified plan. The life insurance has that as well. But what's special about this is distributions, if planned correctly, come out tax-free. And it's liquid, but you do need to be in it for 7 to 10 years for the math to really, the tax deferral math to really make sense. So let's just kind of look at the accounting to this. It's called FIFO, or first in, first out accounting. So in that same $100,000 that you put in that grew to 250 with $150,000 of growth, if your client came to you at 62 or whenever and said, give me 200,000, we're doing a family vacation around the world, here's what happens on first in, first out. You take your basis out first, tax-free return of principal. And then when you get into the growth portion, we take it out as a loan. Okay, loans are not reportable to the IRS as income. The good policies, another replacement statement here. Old contracts, there were net costs to loan out monies from your policy. Newer policies, we're looking at a 4% charge, a 4% credit back, what they call a wash loan provision. So it makes sense to loan out your own money, right? So back to the cylinders of money. I oftentimes at the end of the meeting will ask your clients, which one do you like best? And I'm literally circling all these cylinders. If I did my job correctly, they're going to basically say, ah, this one over here, right? But I'm going to argue that point, and I'm going to go over to this column right here, qualified monies. This column is so good for you that the IRS limits how much you can put into it. They don't limit what you can put into these other cylinders, right? But over here, as a under 50-year-old, you can put in 19.5 in your 401k plan, right? You get to 50 or older, you can put in 26,000. If you're a business owner in the solo K or the SEP, you're at 58,000 under age 50, or 63,000 or 64, one of those, when you get over age 50. So which one of these is best? Well, the answer really lies into this right here. Think about an investment, any investment that you work with your clients on. You have diversification within that investment, right? The concept or the idea of the cylinders of money deal is this. It's tax diversification. You've heard it before. You are looking at the distributions. Some of these will be ordinary income, some will be capital gains, some will be tax-free or tax-favored. Wouldn't it be neat to get out to retirement and have monies in all of these cylinders where you can literally pick and choose and control your tax brackets, right? So first thing you need to understand, or maybe it's the last thing you need to understand, is we are using life insurance. You have to be healthy enough to be able to get it, right? On a scale of 1 to 20, some carriers go A to Z. Table 1 is perfect health. Table 20 is uninsurable. Let's say that your client comes in and they're at table 3. So the question is, can we design this where the relationship makes sense? What is the cost of tax versus the cost of the insurance in that whole relationship amongst the different cylinders? And when we really get down to this, when we can prove mathematically that the cost of tax is greater than the cost of insurance, then this cylinder over here becomes part of a recommendation. I will tell you, when I sit there in front of your clients, it's 15, 18, 20% of your long-term savings over here. If somebody's making a couple $1 million a year, they could put $400,000, $500,000 into this cylinder right here. There's no controls, there's no limits. I should say there's no controls. The IRS limits how much we can do. You just got to buy more life insurance. And if they can financially be approved for it, then this makes sense. So those are my 10 minutes or so of thoughts. I know BREW is designed to be pretty quick. If there's any questions, please type them up, or however Danielle or Abby want to do that. So I'll hand it back to you. Thanks, Abby.
Thanks, Bill. Great share. The line is open for questions if you'd like to unmute yourself or just simply use the chat box. Great share, Bill. I like that you touched on 7702, so thank you. Excuse me. Thank you for mentioning that. And
sure. You like that geeky comment in there? Thanks.
We can get geeky.
Yes, we can.
And it sounds like it's Super-Roth season based on what you've just shared. Okay, question from the audience. Could reposition money from non-qualified to insurance bucket doesn't have to be income?
Great question. I will tell you that a lot of the sales that I'm involved in is taking a taxable portfolio, taking the earnings or maybe earnings in some of the corpus and bringing it over into this cylinder. So you think about how do you get to a point of 55 to 60 years of age and being balanced in these different cylinders when you're so usually unbalanced in these first two, right? So it is taking monies from here, dropping them into some of these other cylinders. And I've seen business owners that actually will take a 72T distribution from their IRAs, and they will take some of those dollars, pay the income tax on it, and shove it over here as well. So good question.
Thanks. Thanks, Dan. Okay, any other questions? I would have thought that would have spurred some more questions. Okay, well, let's go right to the drawing, Bill. If you could give me a number between 1 and 26.
17.
17. Who's the winner? Who's the winner? Eric Swanson. Congrats, sir. Be on the lookout for a coffee card and a CE credit coming your way from all of us here at E4. And thanks for tuning in today. And be sure to tune in next week. We'll have our partner, Brad Mills of Symetra. He'll be sharing also recent 7702 changes and the planning opportunities that now exist in this environment. Thanks, friends, and make it a great day.